Going back, an alternative solution for 8-1 would be to compute for your collections. Because as mentioned before, your realized gross profit is simply the markup on your collections. To solve for your realized gross profit, you only need your collections and your gross profit rate. Okay, and one way for you to determine your collections here is by determining how much was your installment sales for the year. Because since this is the first year of operations, your installment sales for the year would basically be just your initial source of installment receivable. And considering that we are already given with the ending installment receivable, the difference between our initial installment receivable, which will just be our installment sales, and our ending installment receivable will already be our collection. And how will we be able to get our installment sales? By using the 1,050,000. Because the 1,050,000 here, the DGP before adjustment would already represent the markup on your installment sales. Now, normally your before adjustment DGP is the markup on your beginning receivable and your installment sales for the year. But in this case, the before adjustment will just be the markup on the installment sales for the year because we will not have any beginning receivable. Okay, so when you divide 1,050,000 by 25%, that will give you 4,200,000. Okay, so that means our installment sales for the year, which will also serve as our initial installment receivable, would be 4,200,000. And then you deduct our ending installment receivable of 1,500,000. You will have a difference of 2,700,000. And that means there was a collection on our receivables in the amount of 2,700,000. From 4,200,000, it was reduced to 1,500,000 because of a collection. Okay, and if our collection is 2,700,000, you multiply that with our gross profit rate of 25%, we would still arrive at 675,000. Okay, let's proceed to 8-2. The question in problem 8-2 is what is the total realized gross profit to be reported in the statement of comprehensive income for the year ended December 31, 2016. Okay, but we are given here with three rows of information for 2014, 2015, 2016. What does this mean? That we have sales from 2014 and 2015 that are still outstanding as of the end of 2016. Okay, and it's important that this information will have to be segregated because they will be using different markup rates. Okay, the markup rate in 2014 was 35%, the markup rate in 2015 is 33%, and the markup rate for 2016 would be 30%. Okay, and basically we're given the balances of these sales transactions as of the end of 2016. So the 6,000 that you see here represents the ending balance of your 2014 sale as of the end of 2016. The 61,500 here represents the balance of your 2015 transaction as of the end of 2016. And then the 195,000 that you will see here would represent the balance of your 2016 sales as of the end of 2016. Okay. And then the amounts under the deferred gross profit would simply be the amounts before your realized, before adjustments for the recognition of your realized gross profit. So similar to problem 8-1, uh, you can just compare the DGP before adjustment with your DGPN. And although the DGPN will not be given, although the DGPN will not be given, you'll be able to figure that out because again, your DGPN is simply the markup on the ending installment receivable. So meaning you get the markup on the 6,000 ending installment receivable, which is 35%, and uh, 6,000 times 35%, that will give you 2,100. And that means uh, the DGPN should be 2,100. And since the DGP before adjustment was 7,230, then that means your realized gross profit for the year is 5,130. That is uh, for your 2014 sales transactions. Okay, so your RGP during 2016 for your 2014 sales transactions is 5,130. And you just do the same procedure for uh, 2015 and 2016. Okay, the DGP before adjustment is 60,750. And then the ending installment receivable for your 2015 transactions is 61,500. And the markup rate for the 2015 transactions is 33%. So you multiply 61,500 by 33%, you will get 20,295. And this amount should be the adjusted or ending balance of your DGP. So that means if your DGP before adjustment is 6750 and then your DGP end must be 22,295, then your realized gross profit should be your realized gross profit in 2016 for your 2015 transaction should be 40,455. Okay, and do the same for your 2016 transactions. You will have 195,000 times 30%, the applicable gross profit rate for 2016 transactions. And that will give you 58,500. And 58,500 should be the ending balance or the adjusted balance of your DGP. And considering the unadjusted balance of your DGP for your 2016 transactions is 120,150, that means the realized gross profit for the year for your 2016 transactions is 61,650. And if you add all the realized gross profit uh, from your from your 2014, 2015, and 2016, you will arrive at a total of 107,235. Okay, and again, you can also work back for the amount of your collection by working back on the beginning installment receivable based on the DGP before adjustment. For example, let's just try for 2014. If your before adjustment DGP is 7,230 and then the markup rate is 35%, you divide 7,230 by 35%. That will tell us that, sorry, it's 35. 7,230 divided by 30%. That will give you 24,100. Okay, and that amount represents the beginning installment receivable for your 2014 transactions for the year 2016. And if the beginning balance for your 2014 receivables was 24,100 and the ending balance is 6,000, that means you had collections of 18,100. And based on our formula, RGP is equal to collections times gross profit rate. You multiply 18,100 by 35%, you would get uh, 7 to 30 divided by 35%, minus 6,000 times 0.35. Okay, so it should be 7 to 30 divided by 35%. It's actually 20,657 and change. You deduct the 6,000 ending installment receivable, you will get 14,657 and change. Then that would be your collection for the year, and then you multiply that with your markup rate of 55%. You would still arrive at uh, 5,130. Okay, so at this point, it's just a matter of comfortability as to how you want to solve for your realized gross profit. So basically, it's the markup on your collections or the amount of adjustment to your DGP. Let's proceed to problem 8-3. The question here is, what is total installment sales? And we are given with the total collections and the installment sales and the gross profit rate based on cost. So how are we going to approach this one? The DGP balance after adjustment is 202,000. And since this is already after adjustment, that means that is the markup on your ending installment receivable. Okay. And since uh, it can give us our ending installment receivable, then when we add that to the collections on the installment receivable, we will be able to uh, determine how much was the installment sales for the year. Okay. So 202,000 divided by 25%. Okay, that will give you 808,000. But one thing you have to be careful of is that the 25% here, unlike the other markup rates in the other problems, the 25% is still based on cost. So the 808,000 that we are getting here is actually still the cost. Okay, so and you know your receivables should are based on the uh, selling price, which should include the markup. Okay, so what do? You multiply 800,000 by 125%. And that will give you your 1,000,010. So your installment receivable end is actually 1,010,000 and not 100 and not 808,000. Okay. So if your ending installment receivable is 1,010,000 and you had collections of 440, then that means your sales for the year is 1,450,000. Okay. That's it. And if you're asked for the realized gross profit for the year, uh, since we are already given the collection of 440, what you have to be careful of is that the answer will not be simply 440,000 times 25% because again the 25% is based on cost. So to get the markup on your 440,000 collection, you will have to multiply. You will have to divide 440,000 by 125%, and that will give you the cost recovered from your collection, which is 352. You deduct that from 440, you will get 88,000, and that is your realized gross profit. Okay, or you simply multiply the cost with the markup rate based on cost. So 352 times 25%, that will still give you 88,000. 8-4 BMW Corporation sells cars on a 3-year installment sales contract on December 31, 2016. The last day of BMW's first year of operations, results of operations before adjustments are summarized below. The question here is, what is the net income? So we will have to take into account the expenses and other sources of income. Okay. First is, let's try to determine our RGP. Okay. Again, RGP or realized gross profit is simply collections times the gross profit rate. And here we have collection of 500,000, but we will not multiply the 500,000 with our gross profit rate because the 500,000 is not applicable to our installment receivable, or it does not apply entirely to our installment receivable because 100,000 of that 500,000 applies to your interest, and that 100,000 should be reported as an interest income. So the collection that should be applied to our installment sales should only be the 400,000. Okay, we already have the 400,000. We just need our gross profit rate, and we can solve that because we're given the sales and the cost of installment sales. Since sales is 1,000,000 and then the cost of installment sales is 700,000, that means the gross profit rate is 30% and the cost ratio is 70%. I hope everyone knows already at this point how we got the 30%. So what you do here is you multiply 400,000, okay, the portion of our collection applicable to our installment sales. You multiply that with our gross profit rate of 30%, you will get 120,000. And then that's already our RGP. You add our other income in the form of interest in the amount of 100. That will give you total revenues of 220,000. Next, you deduct your expenses in the amount of 80,000, and you would get a net income of 140,000. So basically here, we're being introduced to other sources of revenue, and we're asked to take into account your expenses to arrive at your net income. 8-5 is the first problem involving repossession. So basically in repossession class, uh, you will have to recover or retrieve the item sold as a result of the customer's failure or inability to pay the balance. Okay, the customer defaulted on the balance on the transaction. So one of our remedies would be to get back the item that we have sold. So the accounting problem here is number one, at what amount will you record the asset that you have retrieved? And the answer there is that it is to be measured at its market value before reconditioning cost. Okay, basically just a variation of your valuation for your inventory. Okay, when we repossess these items, they will still go back to our inventory. It's basically the market value before any reconditioning cost. And uh, in most problems, the problem will ask you to solve for the market value before reconditioning cost, and you will have to use the estimated selling price and then deduct reconditioning cost and the normal profit margin on the sale of these repossessed items. Okay, so reconditioning costs are basically the amounts that we have to spend to make the uh, repossessed item marketable. Okay, so basically they become second-hand items already, and we will have to recondition them so that they will be marketable. Okay. Basically, again, the market value before reconditioning cost is just a way for us to recognize the repossessed merchandise at the lower of its cost or its net realizable value. Now, going back to the question, this is a very common question, and this is one of the questions that will be considered as difficult. What is the gain or loss on repossession? If you're asked for gain or loss on repossession, you only need two things. Number one, the market value before reconditioning cost for your uh, before reconditioning cost for your repossessed merchandise, and number two, the unrecovered cost. Okay, basically, the unrecovered cost is the cost component of your receivable that you can no longer collect. Okay, every time you make a collection, we will allocate that amount to the recovery of the cost of the item sold and the profit that we will have to recognize. We will have to recognize. But if the customer will no longer pay, then we will no longer be recognizing the we will have to eliminate the unrealized gross profit related to that receivable. Okay, unlike your regular sales, that if the customer will no longer pay, you just have to write it off and charge it out against doubtful accounts expense. Here, there's no need to recognize another expense because in the first place, we did not recognize them as an income yet or as a revenue yet. Okay, that's one of the benefit of using the installment sales method. Okay, we delay the recognition of the profit only after collection to avoid overstatement of our revenues, even though there is a significant risk on our part that we will not be able to make full collection. Okay, and since we delayed the recognition of the profit only after collection, if collection is no longer possible, then there will be no need for us to recognize a loss from uh, bad debts. Okay, and again, unrecovered cost, you only need two things, the market value and the unrecovered cost. The unrecovered cost is simply the cost component of the remaining receivable that is not fully collected. So for you to be able to determine your unrecovered cost, you will have to determine the remaining balance of the installment receivable that ended up not being collectible. Okay. So again, For gain or loss on repossession, you only need two things: market value and the uh, unrecovered cost of the item sold. Okay. For your market value, the problem will not always give you the market value before reconditioning cost. So you will have to solve that by using the estimated selling price after reconditioning and then deduct the reconditioning cost and the expected normal profit margin. For your unrecovered cost, that will also not be given directly. The challenge there is for you to determine how much is the remaining receivable that is no longer collectible. And whatever is the cost component of that amount, that will be your unrecovered cost. So let's try to apply that in this problem. Uh, During the year, the sale is 80,000. The gross profit rate based on cost. You will have to be careful with that. During the year, a total of 42,500 was collected. Okay, but understand that the 42,500 includes interest of 12,500, meaning the amount of collection that is applicable or to be applied to our installment receivable is only 30,000. Okay, and then no collection was made in the sale and the merchandise was repossessed. The fair market value of the merchandise is 34,000 after reconditioning cost of 4,000. What is the gain or loss on repossession? So remember the two things: market value and unrecovered cost. So start with market value. We have here the fair value is 34,000, but that is already after reconditioning cost. What we need is the market value before reconditioning cost. So we will have to deduct the reconditioning cost of 4,000 here. Okay, and this is normally what will happen in most problems. The only amount that you will have to deduct would be the reconditioning cost. So the amount that we'll be using would be 34,000 minus 4,000, and that is 30,000. That will be our market value or fair value at the time of repossession or before reconditioning cost. Okay, basically we're looking for the fair value or market value upon repossession. That's why we will have to deduct reconditioning cost. So we have 30,000. Next is to get the unrecovered cost. And to get the unrecovered cost, you will have to solve first the remaining receivable that is no longer collectible. Okay, your sale was at 80,000 and then you were able to make a collection of 30,000. So that means there's a balance of 50,000. And that's the amount that we are no longer able to collect. And that's why we are repossessing the merchandise sold. So it's 50,000 and then since the markup rate is 25% cost, you divide 50,000 by 125%, you would get 40,000. That's the cost component of the 50,000 receivable. So that means our unrecovered cost is 40,000. And then considering that the uh, market value at the time of repossession is uh, 30,000 and then our unrecovered cost is 40,000. That means we have a loss of 10,000. Okay, obviously there's a loss because we were unable to recover 40,000 of the cost of the merchandise sold. Okay, and in exchange of that, we just took back the item sold, but the value of the item sold is now only at 30,000. Okay, so you have a loss of 10,000. Or if you want a rule, if market value is lower than the unrecovered cost, then that's a loss. If market value is greater than the uh, unrecovered cost, then uh, that would be a gain. Okay, but if you'll be asked how much will be the gain or loss on repossession, you just get the difference between the market value and the unrecovered cost. Okay. 8-6 is a fairly easy question. What amount should Casablanca Incorporated report as DGP or deferred gross profit? Again, your deferred gross profit is simply the markup on your receivables. Since we are asked for the ending balance of the DGP, then we only need to look for the ending balance or the markup on the ending balance of our installment receivable. Okay, but we're not given with the ending balance of our installment receivables. We'll have to solve for that. First, we need our installment sales, which is already given, and then we also need our collections on these installment sales, which is also given. So if installment sales is 1 million and collection and installment sales is 200,000, that means the remaining installment receivable would be 800,000. Okay, and what we need is to determine the markup on this 800,000. And to get the markup on this 800,000, we need to solve for our gross profit rate for our installment sales. And we can do that since we are given with the cost of our installment sales. So if installment sales is 1 million and cost of installment sales is 500,000, that means our gross profit rate is 50%. So all you have to do is to multiply the 50% with our computed ending installment receivable of 800,000. So 800,000 times 50%, you would get 400,000, and that would be our BGPM. And if you will be asked for your RGP for the year, so you will just have to multiply your collections and installment sales of 200,000, multiply that by 50%, and then you would get 100,000. Okay, if you will be asked to solve for the net income of the entity, regular sales of 600, cost for regular sales of 300,000. So gross profit on regular sales is 300. You add the realized gross profit of 100, you will have 400,000. And then you deduct operating expenses of 100,000. The net income in this problem would be 300,000. Uh, Next, JJ Company sold goods on installment for the year just ended. The following reported. The repossession resulted to, so again, when solving for gain or loss on repossession, you just need to compare two things: the market value at the time of repossession and the unrecovered cost. We're already given with the fair value of the repossessed merchandise, which is 120,000. We just need to get the uh, unrecovered cost. Okay. So basically, class, these repossessed accounts of 200,000 represents the receivable that pertains to those that are no longer collectible and which resulted in repossession. So the 200,000 here is the receivable related to the repossessed merchandise. So what we need aside from the 200,000 would be to simply compute for the cost rate or the cost ratio. Okay, and that's not difficult to determine because we are given with our installment sales and the cost of installment sales. The cost of installment sales is 2,025,000 divided by installment sales of 3 million. That means the cost ratio is 67.5%. Okay, that's the cost ratio, the complement of the gross profit ratio. So you multiply the cost ratio of 67.5% with the repossessed accounts or the balance of your uh, installment receivable attributable to the repossessed merchandise, which is 200,000. That means your unrecovered cost would be 135,000. Okay, and then since the fair value of the repossessed merchandise is 120,000, uh, there's a difference of 15,000, and since the fair value is lower, there will be a loss of 15,000. Okay, hopefully problems on gain or loss on repossession will just be this amount. Okay. 8-8. Same question, gain or loss on repossession, but at the same time, we're asked for the realized gross profit. And how else is this problem different? Um, just the same. Okay. We can solve for the RGP first. For RGP, we need collections and the gross profit rate. Uh, what was sold was land, and the cost is 90,000, and the selling price is 240. So 90,000 divided by 240 will give you 37.5%. That means the cost ratio is 37.5%, while the gross profit rate is 62.5%. Okay, be careful. In this case, the gross profit rate is significantly greater than the cost ratio. Normally, in the problems we've encountered, it's the cost ratio that is greater than the gross profit rate. Okay. Then, from that sale, we received 35,000 cash as down payment and a mortgage note for the balance. Okay. Installment received in 2015 reduced the principal of the note to a balance of 200,000. Okay. So the sale is 240,000. There's a down payment of 35. So the balance, the note really is just for 205,000. And since after the collection in 2015, the remaining balance on the note is just 200, so that means only 5,000 was collected on the note. Okay, so the 5,000 collection on the note plus the down payment of 35,000, that means the total collection for 2015 is only 40,000. And you multiply 40,000 by 62.5%, that will already be our realized gross profit. Okay, and there's only one choice with 25,000, so the answer here should be letter B. But for the sake of practice, let's try to solve for the gain or loss on repossession. We've already determined that the receivable attributed to the that was defaulted is 200,000. Okay, and this can lead us to our unrecovered cost. You multiply 200,000 by the cost ratio of 37.5%, you would get 75,000 as our unrecovered cost. The other thing we need would be the market value at the time of repossession. And since there are no other information given, the appraised value will already serve as our fair value at the time of repossession. Since the uh, fair value at the time of repossession is 165,000, and then the unrecovered cost is only 75. That means we will have a gain on repossession of 90,000. It's possible that we had a gain here because the cost was very low relative to the selling price. In case you will be asked us how much is the gain or loss on repossession and it results in a gain, you will have an answer. But if the question is how much gain will be reported in the income statement, the answer would be zero. Okay, gain on repossession will not be recognized. Okay, because in that case, the asset will actually be uh, impaired. Okay, so it will still be written down to its net realizable value. Uh, let's proceed to 8-9. The gain or loss in possession and the RGP. Okay, so basically the same, but the challenge here is that your collection class will include uh, interest. Okay, so you'll have to set that aside. So the biggest challenge here really is on the determination of the amount of collection that will be attributable or applicable to your installment sale. Okay, and considering that the monthly payment is fixed, but the interest income is diminishing because it's based on the outstanding balance. Okay, and considering there are 4 months of payment, you will have to prepare a table here for you to get the total collections. Okay, and in this problem, I want you to uh, determine the collections. Okay, and out of your monthly collections, the amount that is applicable to the principal should be 2,810 and change, while the amount applicable to interest should be 439 and change. Okay. So if we're trying to solve for RGP, the collection here should be 2,810, and you multiply that with the gross profit rate of 35%. Okay, that's the complement of 4,550 cost divided by 7,000. Okay, and the RGP here would be your 983,000 and 78 centavos. Now, for your gain or loss on repossession, you just compare the fair value at the time of repossession and your unrecovered cost. In this problem, the fair value was estimated at 1,875. We just need our unrecovered cost. And then the unpaid balance after the payments, after splitting the payments between interest and principal, the defaulted balance or the defaulted account will just be for 4,189, and you multiply that with uh, you deduct the markup on the 4,189, or you multiply that with the complement of the 35%, you multiply that with the 65%, you would get an unrecovered cost of 2,723. Okay, and that will give you a loss on the possession in the amount of 847.98. Okay. So your task here would be to come up with the amount of 2,810 for the collection attributable to the installment transaction, and the 439 and change as the amount of applicable to the interest. Okay. 8-10, what amount should Lexus Company report as DGP in its December 31, 2016 for 2015 and 2016? 2015-2016 sales. Okay, so we'll focus on the 2016 statement. As of 2016, the balance of our 2015 sales would be, it was 300. Installment sales in 2015 was 300. We were able to collect 100 in 2015, and then we were able to collect another 50 during 2016. Okay, and but there were write-offs of 25 in 2015 and 75 on, excuse me, in 2016. All this is pertaining to the 2015 sales. That means uh, the remaining receivable as of the end of 2016 for our 2015 transactions would be 50,000. Okay, and you get the markup on this 50,000. You multiply this with uh, 30%. 50 times 30%. That will give you 15,000. Okay, and then for our 2016 transactions, you will have 450 sales minus collection of 150 minus write-offs of 150. The balance as of the end of 2016 for our 2016 sales would be 150. And the markup on this would be 40%. So you multiply 150 by 40%, you would get 60. So our total DGP then would be 15,000 for our 2015 sales, and then 60,000 for our 2016 sales. So a total of 75,000, which is letter C. Then question 11. um, Okay, and you would also be asked for RGP here. Let's just have 8-11. Mustang Company sold a car to Mr. De Jesus for 1,050,000. On this date, the car cost 735. Mr. De Jesus paid 150 as down payment and signed a 900 interest bearing note. 10% note was payable in three annual installments of 300,000 beginning January 1, 2016. Mr. De Jesus made timely payments for the first installment on January 1 of 390, which included interest of 90 per day payment. Mustang Company's installment method. What amount should Mustang Company report as DGP? Okay, so it's just DGP, the markup on your ending installment receivable. So let's get our uh, installment receivable. Okay, so the installment sale was 1,050,000, and then deduct the down payment of 150, and then deduct the collection of 300. Even though the payment made by the customer was 390, the amount that will be charged our installment receivable will only be 300. So there will be a balance of uh, 600,000. Okay, and then you will just have to determine the markup rate. Since the sales price is 1,050,000, And then the cost was 735. So 735 divided by 150 will give you 70%. Okay, so that means the cost ratio is 70% and the gross profit ratio is 30%. So you just multiply the 30% with the balance of the receivable we've computed, uh, which was was it 600? 1,050,000 minus 150 minus 300. Okay. So 600 times 30% will give us 180,000. Okay. I'll take a break first. I'll continue with 8-12 in another video.